Well, joining us now is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, hello to you. The oil market, as we were just discussing there, one I know you've been watching closely. I just wanted to get a check on how these prices that we're seeing at the moment really feed into your overall expectation for oil drivers.
Yeah, I do believe we're going to see a $10 rally between now and this time next year. I can see WTI closer to $60 a barrel, $10 higher. I think right now a lot has to happen. There's a lot of moving pieces, especially with non-OPEC members needing to cut production by about 600,000 barrels a day. And will that happen? Will they be able to comply? But I do believe they will. I don't think it's going to be perfect by any stretch. I think we're going to have violent swings like we've seen most recently. And honestly, that's what we're seeing today. It's more of a reprieve of the market. But I do believe that, this is not November 2014. Members and non-members alike don't want to go through, don't want to relive what they relived in early 2015 going into 2016. So I do think people will comply as best as they can to get oil into at least a rebalanced scenario.
So if you're seeing tighter markets ahead, over what time frame, when do you expect that tightening to occur?
Well, I've been way early on rebalancing. This time last year, I thought we'd be rebalanced by now, but when you had the influx from Nigeria and Libya, I was dead wrong. I do think we could see a rebalanced, or a balanced scenario by late first quarter, early second quarter of 2017. But we do need to bear in mind that a balanced market doesn't mean a market that's going to go down or go up. It's just a market that functions properly, and then we'll go back to its fundamentals.
Okay, so let's take a look at the day's trade, and we have seen relatively muted action on Wall Street. If, Larry, we consider the fact that we've already had the US election, we've had this OPEC meeting, which, as you say, surpassed expectations, and also that Italian referendum, the calendar's looking pretty sparse. Is that creating an issue for traders trying to find their in?
Yeah, you're exactly right. I mean, right now we're looking forward to ECB on December the 8th, this coming Thursday. Then a week from Wednesday, we have the Fed decision. But it seems like both of them are prerogative of what's going to happen. It seems like markets are almost looking past that and just trying to square up for 2017 and putting 2016 behind us. Could there be a curveball from Mario Draghi? Of course there could. We don't think there will, but consensus seems to think that he will extend APP for at least another 6 months and then begin tapering. And that is actually good news because maybe it's an opportunity for European banks to start rallying, as we've seen here in North America. And the same goes for the Fed that's speaking on the 14th. I mean, it's 100% priced in that we're going to see a rate hike in December, and then the dots for 2017 or the rate trajectory will be left alone.
So walk us through your growth strategy then, Larry. How are you advising investors to position themselves amongst all of this sparsity and this potential headwinds that we do have coming up from ongoing political concerns?
Yeah, because, the headwinds are really troubling to me. A rising dollar, we have rising yields. Both of those can and will affect valuations of equities, corporate earnings, et cetera. But that said, I'm cozy with the growth story right now, not forever, but right now. And what that means, I continue to be into cyclical issues, less than defensive issues. I like credit, and I continue to like commodities for the short term. I do think there's an overwhelming amount of euphoria coming out of the United States with regards to the new president, but infrastructure projects, tax breaks, et cetera, there's still headwinds that need to be faced. But I do believe for the short term, the growth strategy is comfortable. That said, I still would keep an extra amount of money in cash, as I've been saying for the past four weeks, because I do believe we'll see some very violent swings in the market, not all of them up or down, but both ways. And I think we can capitalize on those exasperated swings or volatility that we'll see.
One of the areas where we've seen huge upward momentum is the US dollar. Now, Larry, you're actually maintaining a positive view on the dollar. You still see that strength sort of remaining in play.
Yeah, I have been so terrible with my foreign currency directions this past year. It's been so hard, but you know, I do know that after 30 years, the currencies, above all, always overshoot. They always overshoot, and when you think that the dollar has gone as high as it's going to go, it's going to continue to do so. But at that point, I mean, I do believe at some point the bottom will drop out. The dollar won't continue on a trajectory that we've seen. I'm now calling for a dollar top probably in the first quarter, but obviously a lot of that has to do with many other moving pieces in the market. But I do think the greenback will be strong against the G10, at least until the first quarter of 2017.
I also wanted to touch lastly on bond yields. Obviously, we've been seeing those rising so fast in the wake of the Donald Trump election. But again, there's still uncertainty within that market also. Talk us through the hows, whys, and wheres in terms of, I guess, essentially what's bugging bonds.
Yeah, you know, that's been a confusing market. Even iron ore, you look at that, rallied 4 days in a row, up 3% yesterday in Dalian when it closed. People scratch their heads. I don't scratch my head as much on that as I do with the bond market. I can't believe that the bonds have rallied as much as they have and tried to put a Y to it. And that the only thing I can really think of is that we have alleviated or arrested inflation or recession risk here in the United States. That's the only thing that I can chalk it up to. I can also talk to illiquidity. There has been a lack of liquidity in the market, a lot of it due to regulations that have been imposed over the last 3 to 4 years. That's always a factor, but I think it's really the arresting of recession risk. People are comfortable and want a risk premium to the bond because they're thinking we'll probably see more of a rotation out of bonds and into equities to get more return for the risk that they're taking.
Absolutely, and when you have that move so far and so fast, you know, it does bring those concerns coming through. You do start to get a little bit jittery. Larry, thank you so much for your time today. We'll catch up with you again soon.
Thank you.